But good morning. Welcome to Maynard Casterison's nonprofit education series, Reporting of New Revenue Streams. We're so happy to have you here. A few housekeeping items. The session is being recorded. Everyone will be muted during the session, but if you do have questions, please type them in the chat function. And after I present, towards the end of the, after Renee and I both present, we will look at those questions and see if we can get those answered for you. Today I will be presenting, and as many of you have seen me before in these series, I am a partner in our tax department here at Maynard Casterison. I lead our tax nonprofit practice and have over 20 years experience in consulting and tax planning for nonprofits. Renee McNutt will be popping in later today in the presentation to talk about some of the accounting best practices when recording the certain types of revenue that I'm going to discuss. Renee is a manager in our accounting and outsourced solutions department and serves on our nonprofit niche committee along with myself. With that, I will go ahead and get my screen shared and start the presentation. Okay, so I think everybody can see that. If not, Renee, please jump on and let me know, but otherwise I will go ahead and get started. Today, we're going to talk about reporting of new revenue streams for nonprofits. And clearly, as I mentioned, I am a tax person, so it's going to be geared a little bit more on the tax side. However, a lot of this still relates on both the financials in your book versus tax. So hopefully you'll be able to learn a few things. Our agenda today. First, why do we need to categorize revenue accurately? There's a lot of reasons why, and I'll run through those, but it's a very important piece of doing your financials. And then we're going to talk about different types of revenue. And as you can see, we're going to get into grants and contributions, program service revenue, investment revenue, rent and royalties, fundraising revenue, a little bit on unrelated business income, and then maybe a couple different things that we might see in other revenue. Why does it matter? First, to properly disclose the donor money or the money that's coming in from different areas, to properly show that on your tax return and your financials. Another reason, public support tests for charities. This is a huge piece, and we look at this in a lot of different ways. There's multiple tests that a charity can pass to be publicly supported, and we have to look at that each year. So for an organization to make sure they have their grants and contributions, miscellaneous income is not a great thing to have for a public support test. So like looking at that other income and seeing how we can categorize that is very important. Another reason is the determination of a state filing requirement. The AG requires certain types of audits and reviews depending on your charitable donations if you are a charity. And so categorizing this accurately can make sure that you are meeting those requirements, or maybe you don't need to do those requirements if they're categorized correctly. Also, the Form 990 filing thresholds. A lot of people don't know that I had a 990 easy one time that went to a 990 solely because they sold stock, and the gross proceeds from that sale of stock was gross receipts for the filing thresholds. So making sure we're looking at those things too for the filing thresholds. Grant applications may require certain categories. And looking at all revenue sources and making sure they're part of your exempt function or they're statutorily exempt, because you may have unrelated business income and it could be subject to tax or partially subject to tax. And so we really need to look at that also. And then IRS audits. Currently, the last I heard, I think there was only 8,000 audits in the last year. So I know Amber did a presentation recently, and the previous, before COVID, it was over 100,000. So there hasn't been a lot of IRS audits on the nonprofit side, but I'm guessing those will start to increase. So we're going to get into grants and contributions. So multiple different areas that you can put your grants and contributions, multiple buckets. First, we'll start talking about federated campaigns. So these are a type of indirect support received from another organization that receives a substantial part of their support from the general public in contributions. So the most common example of this that we see is the local United Way campaigns of agencies. So if the org itself is a federated fundraising agency, then they would list their contributions in the other categories. But if you're receiving money from like a local United Way or something similar to that, then we'll want to make sure that we differentiate that and we list that separately on our annual filings. Membership dues when it comes to contributions. So I will talk a little bit later about membership dues when it comes to program service, but for membership dues for contributions, these are reported in the contributions section when those dues are less than $75 and are paid to an organization with the benefits that the person is receiving is very insubstantial. There's insubstantial value to those benefits. So examples of insubstantial benefit would be, access to the exempt organization's facilities or discounts in their gift shop or cafeteria or free parking if you have a membership. So those are very low value, and with the membership dues being under $75, those are actually considered a contribution. Fundraising events. We do break out fundraising event contributions. I'm not going to talk about it here because I have a whole nother slide on fundraising revenue. But just as a thought until we get to that slide, that we will break out those types of contributions. Government grants. This can be an area that's a little bit sticky. So government grants are amounts received from a government unit to support the activities from which the organization was granted exemption for. So government grants can be reported in both grants and program service revenue. The tax distinction lies with whether the amounts received from the governmental unit benefits the general public or the grantor. We run into this a lot with a lot of organizations. So if the grant is provided to encourage the grantee to carry on programs and activities that further its exempt purpose, rather than to benefit the grantor or the government, then this would be considered a contribution. An example of that would be a grant to maintain a facility for the direct benefit of the public, such as a library. Those would be a contribution. When a government unit is considered program service revenue versus a contribution is when it serves as a direct and immediate needs of the governmental unit. An example would be a grant for research for its that the results would be used by the governmental unit for its own purposes. So in summary, funds received that are meant to benefit the general public would be a contribution. But if the org has a contract with a governmental unit to provide a service, a fee for service that benefits the government unit, then it may be program service revenue. One side note is that it really doesn't matter if it says grant or contract at the top of the document that you receive. You really got to look and see who the grant is benefiting. Please do know, we have had this a few times, that Medicare and Medicaid payments are considered payments made on behalf of the individuals and therefore are not considered contributions, but rather program service. It can be split. An example would be if you have a nonprofit that is a health and human services organization that provides mental health services to the individuals in the community, the city may provide grant funds to the organization to carry out its exempt activities for the benefit of the overall population that it serves. This is grant revenue. It's for the benefit of the public, carrying out the organization's mission. The same social service agency also administers an EAP, an employee assistance plan for local employers as part of its mental health services. If the city then contracts with the organization to administer the city's EAP for those city employees, these funds would be contracted services and reported as program service. So this can make, the reason it's a big difference is it really can make a big difference on a charity's public support test, depending on which test you are using. So it's very important to talk this over with your tax preparer. We always look at this when we're doing our taxes. So all other contributions are really just that. They're not categorized in any of the above contributions. They can be grants from individuals, private foundations, corporations, states, trusts, all those types of taxpayers. They are included in this if they are, grants would also be included in this group if it's not a government grant, if it's the definition of a grant that is helping the organization with their exempt purpose. And typically you'll see donor advised fund contributions are also recorded here. Then we have non-cash contributions. So non-cash contributions are going to be things like, that are non-cash, like clothing, household items, art, marketable securities, land, food. And all those non-cash contributions should be valued at receipt. If the organization, just a side note, if they receive more than 25,000 in non-cash donations, be aware that there is additional reporting, and the organization will need to kind of keep better records of the different categories of the types of contributions that were received and the value of those non-cash contributions. So keep that in mind when accepting non-cash items. There's also in-kind services and rent. We see this quite often. It is recorded differently for tax purposes than book purposes. These are going to be your donated services or pro bono work that might be done, and also the use of facilities for free or reduced rent to an organization. These types of revenues, like I said, are typically reported on financial statements, but not for tax purposes. Typically, the financials will have a revenue account and an expense account, and so they will net to zero. So you won't see a net income change on your tax return, but you will see a difference in the amount of revenue or expenses that are reported. Sometimes due to timing differences, there could be a difference. And then for tax purposes, we will do a net asset adjustment for that. So just to keep in mind on those in-kind services and rent. Program service revenue. So program service revenue is revenue generated from an exempt org's programs. The services are various programs that form the basis of the organization's exempt purpose. Every program is unique to each exempt organization. Usually they've applied for exempt status, explaining the different programs they're going to do. And simply just because it's one organization's activities may be exempt from tax doesn't automatically make income from that same type of activity exempt for all other organizations. It really goes back to what your true mission and exempt purpose is. Some examples would be membership dues, which we'll talk about in a minute why that's different, rental income from low-income housing, tuition and fees associated with education, museum admissions, conference revenue, other member activities. Those would be types of things that would be listed under program service revenue. And also, as mentioned before, this is also where fee for service and contracts from governmental agencies are recorded. So on the membership dues piece, the difference here is that usually this is from membership clubs, which are primarily going to be your social clubs, your labor organizations, your trade associations. They will report membership dues as program service. Because typically members, excuse me, pay dues to these organizations to receive certain member benefits in return for their payment. So they're receiving a benefit in return for their payment. Some of these examples of these benefits would be subscriptions to publications, newsletters, education, lobbying efforts, things like that. Even if the dues are paid and the benefits aren't utilized, it's still going to be considered program service revenue. These should be listed as separate activities. For tax purposes, we will list your top 5 out of program service revenue, and then we will aggregate the remaining ones. But this does correspond directly into the second page of your 990, where all organizations must list out their top 3 programs based on expenses. And this is really where the organization can highlight the things that they are doing in their programs. Important piece about recording this revenue is if you're a charity, you will have to break out the revenue and expenses associated with each program that you're listing on page 2 of the 990. So it's important to know if the revenue associated and the expenses associated with each program. And I think Renee might tap in a little bit later on how that's easily tracked in like a QuickBooks setting. Organizations can have new programs that they establish. That happens a lot, especially now we see a lot more new revenue coming in on organizations trying to find new ways to bring in revenue. But you have to go back to your original application or your governing documents and make sure that that activity is within your exempt purpose. There are avenues to add, maybe change your exempt status, but you'd have to get approval from the IRS for that type of thing beforehand. So you'll want to make sure that you're looking at that, because it could end up being a taxable situation if it is not related to your exempt purpose. And that's okay. There's many organizations that have those types of activities and pay tax on it for that additional revenue. Program services can be bifurcated between program related and UBI. An example would be like a social club who has revenue it receives from like using the swimming pool. The revenue can be bifurcated between program service, which would be for the members, and UBI, which would be for non-member activity. I'll just quickly touch base on investment income. We all kind of know we got interest and dividends are usually from your bank accounts, your investment accounts. Now, on the interest side of it, interest-bearing investments that are part of the organization's exempt purpose would be reported as program service revenue. So an example for this would be if you have an organization that lends money, their primary purpose is to lend money to low-income housing organizations or projects, then the interest received on just that lending piece would actually be considered program service. And this is important because certain tests for the public support give limits on how much investment income you can have. So it's important to categorize, as I keep saying, revenue the correct way. We got realized gains and losses. Oh, sorry. Realized gains or losses. This is capital gains. They're usually statutorily excluded. These are gains from capital assets, partnership interests, real estate, and others. Sale of S Corp interest or debt financed property may cause a tax situation. So you'll want to touch base with your tax preparer if you do have those two situations. I will note there are different rules for investment income for organizations under 501c7, 9, and 17. Typically those are reported on an NIDT and have a little bit different filing requirements. So if you are one of those organizations, we'll want to look at that. And then there's unrealized gains or losses, which aren't reported on the tax return. It's a reconciling item. Those are going to be the change in values on some of those investments that aren't recognized. I will note that on investment income, one thing to note is that if you do have a for-profit subsidiary to your nonprofit and you have any type of passive revenue like interest, rent, royalties, things like that, those could be a taxable situation. There are some cutout rules for if those types of transactions are going between a nonprofit and a for-profit that you own 100% of. So just keep that in mind. Rent income. There's two types of rental income. I know my staff get annoyed because every time there's new rental income, I'm always asking 100 questions to them. So there's two types. There's real property mostly and personal property. It's very important to look at a lot of things when you take on new rental income. You need to consider the type of property it is, real or personal. So real property is statutorily exempt from tax unless there's certain things that happen during that rental process, and I'll go through those. And then there's personal property, which is usually always taxable. There's some cases where if you have a lease agreement that has both, if you meet certain standards, the personal property might be de minimis and you wouldn't really have to worry about it, but something to think about. You want to see if the rental activity is related to an exempt function because it could be program service revenue. Like if you're a low-income housing organization and you're renting, that could be program service. Like I said, if there's a combination of real and personal properties rent, you want to look at the contracts on that. You want to look at and see if there are substantial services also provided within the lease agreement outside the normal landlord services. This would be, I see a lot where a organization has a rental agreement with another organization in their building, and they're also providing back office services because they realize like this organization maybe doesn't have an accountant, so they're helping with the accounting or something outside of the normal landlord services. Those services could potentially in most cases be taxable, so we'll want to look at that. And then is there acquisition debt on the property being leased? So whenever there's rent, the first thing I do is look and see if there's a mortgage. If it's an acquisition mortgage, and then we're renting it out, we're going to have to do a calculation and report some of that rental income on the 990T and pay tax. So I would say if you're going to take on any type of new rental activities, it's important to look at these things and contact your tax preparer to see if we should plan ahead for some UBIT activities. Royalties. Royalties is another one where we have to analyze the contracts. Royalty income usually consists of amounts paid to organizations for the right to use an asset for the organization. Typically, it's exclusive or non-exclusive to an intangible asset, usually the name, image, process, or mailing list. Royalty income can be related to the organization's exempt purpose, or it can be statutorily exempt. Typically exempt if certain things. It's kind of like rent. You got to make sure you fulfill certain things. Royalty must be in a passive nature. So no substantial services can be tied to the same agreement. If the organization does provide substantial services in connection with the royalty agreement, the IRS will assert that the income is unrelated business income. It's important to look at those contracts. It really doesn't matter if the contract says royalty agreement at the top. You really got to look through it and see what's happening, because that's exactly what the IRS will do. So read through those and see what they say. If you do have an agreement that's a royalty agreement that also has services associated with it, I would really highly recommend looking and thinking about bifurcating that agreement. If you can get two agreements and you have one that's solely for the royalty and then one that is for the service piece of it, then it's much easier to be able to say, okay, this royalty income is not taxable and this piece is taxable. And that would be, I think the IRS would be much more willing to use that in an audit. So definitely something to consider. Sorry, excuse me. Fundraising revenue. This is one area that I feel like we could do a lot better at tracking in a lot of organizations. It's a hard thing to track, but by their nature, fundraising events are generally not regular programs or activities and are held infrequently, usually once a year. As such, these special events are not regularly carried on and are exempt from unrelated business income tax. In order to have a fundraising event, the activity must meet three criteria. The primary purpose of the event is to fundraise. There's a quid pro quo element, and the event or activity is not regularly carried on. Quid pro quo is really just means something for something. So this is, I come to an event and I come to a golf outing and I'm getting golf fees paid for with my purchase or with my donation. Or I go to a breakfast and I'm getting a meal. So that's that quid pro quo aspect to the fundraising event. So most annual fundraising events like galas or tournaments, golf outings, breakfasts, things like that are not considered regularly carried on because they are infrequent. Gross income from special events is split between fundraising revenue and contributions. This is important because we want to show as much contribution revenue as we can, because the gross remaining fundraising revenue does not help support your public support test. The contributions do. So there's things that we want to make sure that we're keeping track of during a fundraising event. And those would be the fair market value of items exchanged, the fair market value of goods and services the attendees receive as part of the attending event. Like I mentioned, the meals, the entertainment, the golf fees, number of tickets sold, we want to know, and those direct costs associated with the event. So definitely need to take good records on fundraising events, and so we can definitely show that charitable portion, and it's good for being able to give donor acknowledgement letters and also for the public support test. Unrelated business income, I will just touch briefly on. Three things that it needs to meet: regularly carried on, so frequent, has to be frequent like another commercial enterprise in that same kind of business line, trade or business, profit motive, and be unrelated, substantially unrelated to your exempt purpose. So it does not contribute to the exempt purpose, no substantial causal relationship. Some examples that we have are the debt finance rental income, personal property rental income that we talked about earlier, advertising. So if you have a newsletter and there's advertising piece to it, typically that's going to be UBIT. We got to look at our sponsorships and make sure that there's not a large piece of advertising within that sponsorship that could be UBIT. and service agreements on unrelated activities, which we kind of talked about earlier. We have lots of presentations on UBIT, but if you ever have a question, please reach out. And finally, other revenue. We've seen lots of random things in other revenue over the years, and we really try to categorize miscellaneous revenue as best we can. There's some things that we're just not quite sure what it is, so we do list it as other revenue, and it's usually pretty infrequent. It might only show up on a tax return for 1 year. Some of those have been insurance claims, credit card reward refunds. We've, the PPP and the ERC things that have come through, those are usually a one-time or maybe two, happens twice. And those are all government grants. So we haven't had to really worry about that being any type of other revenue. But we do like to minimize as much miscellaneous other revenue as we can. And here's my contact information. If you have any questions afterwards, feel free to reach out to me. And I will go ahead and stop sharing so that Renee can talk.
Thanks, Brandy. All right, I'm going to share my screen. Is everyone able to see it? Oh, Brandy, I'll wait to see if you have anything to say. All right. So I'm Renee. I'm going to be going through some best practices for revenue classification. Starting off, how to utilize account groupings. So this just helps keep the statement of activities organized. It helps ensure accuracy in reporting and helps identify those key revenue accounts that Brandy just walked through for your 990 and for your audit preparation. Also can help with some of those tests that she referenced for the AG office. We also have common account groupings. So from a high level, we have like grant revenue, which is revenue recognized as grant expenditures occur. It's typically broken out into a couple accounts that show state versus federal grant dollars. Each line item in this account grouping likely has grant agreement or notice of awards to support it. And then next we have public support. This grouping usually contains contributions to organizations received from both businesses and individuals. And then fundraising includes the income from special events or fundraisers put on the organization. Lastly, the other income grouping typically has the interest income, income from investments, and any unrelated business income if it's minimal. So here I just have like a quick screenshot from a client that I was using an example of. You can see here that they have their grants kind of broken out up here and then some together. They have their public support broken out between both individuals and businesses. They have their other income with their interests, and they happen to have some rental revenue that's not super significant, but they're outlining it here. And then lastly, we can see their special events income. And they have it broken out between like contributions, and also they record their direct expense underneath it. So another great tool you can use within your accounting system is the classes and customer functions. You can set up a class for each grant received to be able to run reports and categorize specific revenue and expenses to the grant. This helps streamline audit preparation and grant reporting requirements. And then classes can also be used for special events to see which event your organization, if your organization has multiple, was the most profitable or which was the most expensive. Also, by using a class, it's easier to identify which expenditures were over $15,000 that were related to a special event. I know Brandy has talked to me about figuring out an easier way to identify those items, because again, that's needed for your 990 preparation. We also, for tracking donors and the public support, we need to track donors that donate over $5,000 for a year to your organization. So a simple and easy tool to use to track that is the information is to use customers. So just as those payments come in from those individuals or businesses, if you're constantly booking them to the customer, this can help us just run a customer list at the end of the year and see how much was applied to each of those, and makes it easy if all the information was added ahead of time, so you're not scrambling at year end to figure out addresses and names and all that fun stuff. And then if you're an organization with a significant number of transactions, a month from various donors, you may want to consider using like a third-party software. Depending on the organization's accounting system, there are some that import details directly into it. I know I have a QuickBooks client that uses Donor Perfect for an example. But if anyone has questions related to that, we're more than happy to assist to help you find the right tool to use. That's all I had. I know that was very quick, but Brandy, are there any questions to go over?
I'd just like to add, when you're talking about I like the customer option for donor. At year end, when we're trying to figure out if a contributor gave over 5,000, sometimes they give multiple ways throughout the organization. They give, $250 47 times or something, or they give to a fundraising event, or they give to that. And so and it's an aggregate amount. So you're able to then easily be able to see their aggregate contributions through the year. Let's see, I do have a couple of questions here. Okay, does rental income from a property that is not debt financed impact property tax exemption status for that property? No, I don't think that affects that. I think the property tax exemption, from my understanding, is a completely different thing and is solely based on your exemption and how that works. It wouldn't really affect anything that has to do with how it's taxed via the 990T. So I think you're okay there. Let's see. A bunch of questions just came in. So we are now offering online education inspirations related to our exempt purpose at no charge. We are going to set up a way for people to make love offerings if they wish to, not necessarily directly tied to these new offerings. Is this contributions? So I would. Oh, so people can make offerings to be able to have these educational inspirations related to your organizations. As long as they're not personally receiving a benefit from that, they might watch those things later. But I think if they donate to your general program that you're offering, then that would be a contribution to them, from them. And then what about donations from silent auctions? So typically in a silent auction, you do have to value, it's still up to the organization to value those items that you're giving. So when someone, and usually in silent auctions, there's a chance to win. So there is no really donation involved in a silent auction. But you do usually have some sort of value that you've come up with for that. But typically, even if they go above and beyond that value, they're still receiving, it's like a game of chance, I guess. So I think that I don't think they get contribution related to that aspect at all on putting something on a silent auction. Okay. I think that was the last question. So thank you, Renee, and thank you for joining us today. Monday, we will email out a recording of this presentation, and our contact information will be in there if you want to talk about any more questions that you might have, or on the questions that we did have. If you want a little bit more detail, please feel free to reach out. Next month, we have a guest speaker from the Michigan Nonprofit Association who will be talking a lot about board diversity considerations. So we're really looking forward to that. And so keep your eyes peeled for the communications regarding that next month, or it'll actually start to come out in the next few weeks. And I hope you all have a great rest of your day. And I hope that this presentation was worth your time. Thanks, everyone.
Thank you.